Welcome to the latest economic update with Professor Joe Nellis. Now, Joe, some good news coming out last week. We're technically out of recession, a growth of 0.1 in quarter 4. What's your reaction?
Well, Andrew, you've said technically out of recession, and that is correct. It's certainly good to see some positive growth, but 0.1, is an estimate, and that estimate is based on 40% of the survey data. So there's a lot more data to be analysed before we get the final estimate, and that 0.1 could be revised upwards or downwards. So it's a very, very small recovery, but it's certainly good news, absolutely.
And what's your forecast for the rest of this year?
Well, I hate to say it again, but cautious. Given how slow the recovery has been in the fourth quarter, analysts were expecting much more and have begun to downgrade their forecasts for the year as a whole. So I think, taking the consensus view, we're going to grow somewhere between 1% and 1.25%, which is not that exciting. Certainly well below our trend, which is more like 2.6%. So it's not going to be a great year, but of course it is hopefully laying a foundation for more solid growth thereafter.
Joe, a quote that hit the headlines last week. Bill Gross of PIMCO, the world's biggest bond fund, said, "The UK is a must to avoid. Its gilts are resting on a bed of nitroglycerin. High debt with the potential to devalue its currency present high risks for bond investors." So he doesn't like the UK economy at all.
Well, I wouldn't have used such emotive language, but he does make a very valid point. The level of government debt, the national debt, is enormous, record level. And of course, it's increasing each year by the scale of government borrowing, which this year will be 178 billion approximately. He's obviously flagging up the fact that the bond markets are getting nervous about whether or not the UK government could or would default on bonds. It won't, by the way. But nevertheless, the risk profile is increasing, and therefore the cost of capital is going to go up. And at the same time, that drives down bond prices. So he's flagging up a concern, as he should, but I think he's using language that is somewhat too strong, given that we are nevertheless a solid economy with a few problems along the way.
So how should the UK tackle its budget deficit? Aggressively, or make the cuts much more slowly so as not to endanger the recovery?
Well, this is going to be the big election issue, of course. Do we go for the Tories and cut quickly, or do we follow the Labour government view, which is cut more gradually and have the debt, let's say, over a 4-year period? The truth is, we're in new waters, new territory. We don't know. I would not be in favour of a quick fix. I can see the attraction of it, take the pain quickly, get over it, and then move on. The problem is the government is such a large sector of the economy that if there's any sharp reduction in government spending in order to pull back the debt levels, coupled with a sharp increase in taxation of the economy, then I think that will spell, I won't say disaster, but it will put the brakes on economic recovery and could actually lead to a double dip. 4 years seems quite a long time, of course. I assume the government's thinking more or less the length of a parliament. I see nothing wrong with that in principle. And on balance, I would probably be a little bit more cautious than the Tories are suggesting, and perhaps veer towards the Labour government view.
Joe, UK unemployment dipped a fraction in December, 7,000 to 2.46 million. Is it likely to rise any more?
Well, first of all, that dip was a surprise. In economic recoveries, we normally expect unemployment to continue rising. It's a lagging variable. So any dip in the context of a recovery of 0.1% was not expected. Will it rise further? Well, I hope not, but I don't think we're out of the deep waters yet. Remember, we have a number of cautionary notes to make. As the year progresses, growth will be very, very modest, in my opinion. Therefore, unemployment will not fall sharply. And if there is a double dip, as we mentioned already, then unemployment could rise again. On top of that, of course, the government has already announced a number of cutbacks, for example, university funding. And that's going to mean a number of students will not get places at university next September. That will have an impact on unemployment figures. So I do not expect to see a significant fall. On balance, I think we could see a reversal and a rise again later this year.
Joe, let's look at the global picture. China's growing very strongly.
Yeah, and of course, in some ways, that's not unexpected. China's a massive economy with massive spare capacity. And as the G7 countries, the big industrialized countries, have recovered, particularly America, so China's exports are growing very strongly. At the same time, their own economy is growing strongly. So they're enjoying the drivers from export growth and domestic spending. And they're doing very, very well. Thank you.
Is there a chance of a Chinese bubble?
There is, of course there is. With growth of 10% plus, it's inevitable there's going to be some inflationary pressures. You cannot adjust to the scale of demand that quickly. And inflation is probably around about 6%. But that's not a bad combination. So is it a bubble? I wouldn't regard it as a bubble yet. There are some years to go before we start getting anxious about China because it has got, as I said already, massive spare capacity.
Joe, thank you very much for your time this morning.
Thank you.